Chamath Palihapitiya expounds on the horrendous financial crisis America is entering. Chamath Palihapitiya, founder and CEO of Social Capital, is a man on a mission. In a recent speech he gave, he expounds on the horrendous financial crisis America is entering. The markets, which are a reflection of our collective hopes, aspirations, and reality, are always in motion. This is why Palihapitiya believes he would rather stick to the historical pattern since it is easier to understand. He warns the world to get prepared for what he believes will be an inevitable, calamitous downturn. He explains why the U.S. economy is unsustainable and how this will affect young investors as well as more seasoned investors alike. Hello and welcome to Finance Sense, where we cover all the latest trends in the financial markets and the economy. Chamath Palihapitiya notes how the current U.S. economy has become distorted as he analyzes the next market crash. So make sure to leave a like, subscribe, and comment below if you enjoyed watching, and turn on the notification bell to keep posted. Now, let's start. According to Chamath Palihapitiya, it is critical to always consider both sides and have an intellectual discussion with oneself and the reasons why each side could be correct. However, what is the other side? The other side begins with energy, since it is the conflation of an economic system and a political system utilizing an instrument. And if you take a look at what is going on in Europe, you'll see that there are a lot of layers to peel back. For instance, the French government essentially announced that they would begin generating less nuclear energy, which would compel anybody to question their motivation. As it turns out, the high temperatures make it impossible to use water to cool nuclear reactions, since the hot water that escapes would wreak havoc on the lakes and rivers' ecosystems. Fresh water is fed into the reactors to keep them cool, but using it to do so would damage the ecology. Second, all of the rivers are at or below their normal levels due to the extreme heat. On the Danube, gas and coal-carrying barges are getting stuck. The Po, the longest river in Italy that provides irrigation to all the farms, is below the level at which it can offload water. Therefore, farmers are unable to effectively generate the food supply as needed. As a result, you can begin to understand that this is a problem where we are once again dealing with a complicated subject, with energy serving as a debate's focal point. The markets, which are a reflection of our collective hopes, aspirations, and reality, are always in motion. This is why Palihapitiya believes he would rather stick to the historical pattern since it is easier to understand. Every time there has been a surge in inflation throughout history, the Fed has had to raise rates over that key threshold of 5% when CPI is above 5% to break enough demand and reset the economy. However, Palihapitiya said that the truth is that governments must remove all of this excess money from the system in order to determine the equilibrium demand level and restore normalcy. The period of cheaper, quicker, and better has come to an end, and together with it comes improved national security. However, the price of this improved national security is higher, and there is nothing that can be done to prevent this from happening. Palihapitiya argues that there is enough excess slack to be absorbed by all of this free money in order to still have steady growth, but this will be accompanied by increased interest rates, inflation, and input costs. This is why the public believes that the Fed should simply be very aggressive and finish this process swiftly for this reason. The issue, however, is that they're unwilling to examine the historical artifact. Over the last 8 quarters, numerous erratic data points have rendered the trendline unpredictable. According to Palihapitiya, the clearest example of this in a particular subsector, an out-of-the-blue huge spike followed by a gradual return to trend. Palihapitiya believes that the question we are waiting to answer is how many quarters it will take for us to start experiencing on-trend economic growth. We had a tremendous shortfall in the second quarter of 2020 and a massive surplus in the third quarter. We've also had a nation working its way back toward achieving equilibrium. Therefore, it is unclear what the steady-state growth should be. This is why Palihapitiya had a problem with how the White House tried to explain why what's happening nowadays isn't a recession, making people doubt the definition. The Fed also made the same statement when they increased interest rates by 75 basis points. They stated that they would no longer provide guidance because the situation was too turbulent. And while they will continue to monitor inflation, they will rely heavily on statistics that will be available soon. Palihapitiya therefore believes that the White House miscalculated and that rather than dwelling on it, we should just concentrate on what we need to do to return to a stable, steady equilibrium. Additionally, Palihapitiya contends that because of the loose financial circumstances, excess money distorts a genuine relationship between supply and demand. This excess money may originate from the government. However, in this instance, excess money from the government ended up in the hands of those who traded on the open markets, which made everything seem distorted. With what appeared like an infinite supply of free money, there was a lot of purchasing activity. We haven't seen a period without nationally introduced spending or federally introduced quantitative easing since the Great Financial Crisis. So we don't know what the natural equilibrium economic growth rate should be now that this money is being pulled out. In other words, over the past 14 years, we have continuously propped up the economy. Palihapitiya concluded that we have distorted the values of bonds, fixed income, and stocks and generated an asset bubble in crypto out of nowhere. As a result, we now need to determine the economy's genuine supply and demand dynamics. When the yields on long-term bonds go down, it tells everyone else they need to reprice their assets. What exactly does this accomplish? It approximately reduces the cost of borrowing. Tech companies, biotech stocks, and cryptocurrency equities increase considerably more quickly. So what has Jerome Powell, chair of the Fed, actually accomplished? He has synthesized a type of easing. If the money supply were a pipe, his duty at the Federal Reserve would be to shrink it in order to stifle demand and bring the economy to equilibrium. As a result, he is essentially enabling market players to assume that the worst has passed, extend the pipe once again, and reach the end state. He effectively put a pin on this year with one speech and informed the markets that he would likely start reducing in the second half of 2023. It's now pushing the problem back another 8 quarters. Never in American history has the CPI risen past 4% or 5% without the Fed's funds staying below 4% or 5% to keep inflation from increasing as well. As a result, inflation will eventually change direction and print between 6% and 7%, but not below 4.5% or 5%. Therefore, if inflation stays at 4% to 4.5%, we may only be halfway there. And Palihapitiya believes this information is not what market players want to hear. They don't want to be told that there needs to be a substantial tightening. Politicians in the White House do not want to hear it either. The concern is that if Fed Chair Powell responds to too much of that feedback, he won't perform what he's meant to do or why he was appointed in the first place. That's all for this video. If you enjoyed it, please like, subscribe, and hit the notification bell to stay up to date on our videos, and make sure to leave your thoughts in the comment section below. This is Finance Sense, helping you keep up with all the latest trends in the financial markets and the economy. Stay safe and keep learning. Until next time.